Today, the Karachi Stock Exchange dropped over 2,000 points.
Yeah, a massive hit.
Right, but if you look closely at the data, the sheer panic you're seeing on the surface might actually be, well, a complete illusion.
It's the ultimate trap of headline numbers, I mean, honestly. A massive drop looks like a mass exodus, right?
Sickly.
But beneath that surface, the underlying mechanics of the market are telling a story of, exhaustion, hidden floors, and primed opportunities.
Which is exactly our mission today. So it is August 18th, 2026, and we are staring down a pretty dense stack of technical market analysis.
We really are.
We've got analysts' notes, 7 distinct technical charts covering the KSE-100 index, along with a handful of individual stocks that are flashing some truly bizarre signals today.
Yeah, some very counterintuitive stuff.
For sure. So whether you are actively trading or you just want to understand how market momentum actually works behind the scenes, we are cutting through the jargon. We're going to show you exactly where the market is pulling back and where the hidden opportunities lie while everyone else is, just distracted by a red screen. Okay, let's unpack this.
Let's do it.
Because the headline number today for the KSE-100 index is, it's aggressive. It closed down 1.27%.
Yeah, a sharp drop.
That is a drop of 2,290.52 points, landing the index at 178,211.92. When people see a 2,000-point drop, human nature just kicks in.
Of course it does.
The instinct is to just liquidate everything.
Which is an understandable reaction if you only look at the closing bell.
Right.
But we have to step back, and examine the actual landscape of the trading day. Yes, it closed at 178,211, but look at the daily range.
It was huge.
Exactly. The market actually hit a high today of 180,602.44 before pulling back to a low of roughly 177,866.
Wow.
And it did this on massive daily volume. I mean, we are talking about over 510 million shares trading hands today.
See, millions of shares moving while the price goes down usually confirms that panic for me. It feels like everyone is just rushing for the exit at the exact same time.
Right. It creates that illusion perfectly. But before we declare a bear market, we always have to zoom out and look at the broader context.
Okay.
Despite this sharp drop today, the one-year change for the KSE-100 is still sitting at a very healthy positive 20.25%.
Oh, wow. Okay.
Yeah, and even the year-to-date change is positive, up 2.39%.
So we're taking a hit, obviously, but we are still well up on the year. It's like a stumble on a staircase, not falling off a cliff.
Precisely. And the most compelling evidence that this is just a stumble is actually hidden in the 4-hour charts.
Yeah, the 4-hour chart data in our sources completely shifts the narrative here.
It really does.
When you look at the volume trend on this specific 4-hour time frame, you start to see the nuance. Back in late June and mid-July, we had these towering spikes in trading volume.
Just massive surges.
Right, massive surges of capital flowing in and pushing the market up. Yeah. But as we've moved through August, that volume has been, tapering off. It's trending noticeably lower.
The volume drying up on these shorter time frames is really the crucial tell here.
Exactly. The notes show that the latest 4-hour volume is roughly 150.784 million shares, which, it sounds heavy until you realize it is sitting well below its 20-period average of 185.433 million.
Exactly.
So the price is dropping, yes, but it is dropping on significantly less energy.
Right.
Think of it like a car rolling backwards down a hill. You see it moving backward, which is alarming, obviously.
Fine, yeah.
But if you listen closely, the engine is actually revving much lower than it was when it was climbing.
That's a great way to put it.
The downward price movement is happening, but on relatively lower momentum compared to the massive buying pressure we saw at the previous peaks.
If we connect this to the bigger picture, the index is clearly in what we call a corrective phase. The market is effectively just taking a breather. The price candles are trending downward because the aggressive buyers from July have stepped back, not because an overwhelming wave of new sellers has just suddenly appeared.
Oh, I see.
Yeah, the data suggests they are letting the market drift down toward a very specific historical target level of 178,094.82.
Which is just a hair below where we closed today at 178,211.
Exactly.
It's just searching for that solid ground to stand on again.
It is normalizing. But within that normalization, individual stocks behave very differently.
And that brings us to the specific boats out there on the water. Because while the overall tide is gently pulling back, some of these stocks are actively taking on water.
They definitely are.
Our sources categorize a few specific tickers as caution zones. These are the ones where the underlying mechanics are setting traps for retail investors.
Right, the dangerous ones.
Yeah. And I want to talk about Pakistan State Oil first. trading under PSO. Because looking at this chart, I actually had to push back a little bit on this caution zone label.
Oh, really? Let's hear the bull case for it then.
Okay, so PSO is currently trading at 375.00 flat. The chart shows it just had this really sharp rally, a fantastic upward run, and right now it has pulled back and is testing immediate support at 374.41.
Right, it is.
So it's resting right on that support floor. If a stock just had a sharp rally and is now resting neatly on a support line, I mean, isn't that the absolute classic buy the dip scenario?
You would think so.
It found its floor and should be ready to bounce back up.
Right.
Why warn people away from that?
Well, if you only looked at the price and the fact that a line exists at 374, you would probably pull the trigger.
Yeah.
But this is where understanding the psychology of the market is paramount. A support line isn't a magical trampoline.
Fair enough.
It is simply a price level where, historically, buyers have felt the stock was cheap enough to step in. But we have to ask, do those buyers still have any money left? Right. To answer that, we look at the RSI, the Relative Strength Index.
The speed limit gauge.
In a way, yeah. The RSI measures the speed and change of price movements on a scale from 0 to 100. It effectively measures buyer exhaustion.
Okay.
And right now, PSO's RSI is sitting near 70. Relying purely on our notes here, an RSI of 70 plus indicates a stock is in overbought territory.
Meaning the last couple of weeks have been almost nothing but up days. Everyone who wanted to buy PSO has already bought it.
Precisely. The rally was so aggressive that the underlying buying momentum is stretched to its absolute limit.
Wow.
There is very little fresh capital sitting on the sidelines waiting to defend that 374 support line.
So it's weak.
Exactly. So
Yeah.
even though it is resting on that floor, the floor is made of glass. The buyers are exhausted. And if that immediate support shatters, the next major historical memory of buyers stepping in isn't until 364.18.
Wait, really? That is a 10-point air gap?
Yeah, it's a steep drop.
That floor gives way, and it's a long, fast drop down to 364.
And even lower, the next support after that is 359.56. And look at the upside. Even if it does manage to hold and bounce, the people who bought at the very top of that recent rally are going to want out the second they break even.
Just to save themselves.
Right. That creates heavy overhead resistance, a ceiling of willing sellers starting around 379.85.
Okay.
And it continues at 390.12. And again at 396.09. The upside is heavily capped by tracked buyers, and the downside risk is elevated because the momentum is just totally exhausted.
It is the definition of a bad risk-reward ratio.
Oh.
You don't want to buy the dip if the dip is just the first crack in the ice.
Exactly.
Now, transitioning from a stock failing due to exhaustion, let's look at a stock failing due to accelerating downward momentum. That's TPL Corp.
Yeah, TPL Corp. It's currently trading at 22.16. And similar to PSO, it has pulled back and is sitting just above a historical support level at 22.08.
But the internal mechanics here are entirely different from PSO, aren't they?
Completely different. With PSO, the RSI was high, showing the buyers were tired. With TPL Corp, we are watching the stochastic RSI.
Okay, the stock RSI.
Yeah. And for TPL, the stock's RSI is actively falling, currently sitting around 19.
That's low.
Very. This isn't just exhaustion. This is active, accelerating bearish momentum. The sellers are gaining confidence and pushing harder.
So if a support floor is tested by exhausted buyers, it might crack.
Yeah.
But if it's tested by sellers who are actively accelerating their pressure, that 22.08 floor is likely going to get smashed.
That is the danger. And if it breaks 22.08, the next safety net is down at 20.54, and below that, 19.99.
Oh, wow.
The momentum is just actively working against you right now and trying to push up. You're hitting resistance at 24.57 and 26.42.
Just a wall of sellers.
Yeah.
Which brings us to the third caution zone, PTCL, trading under PTC.
Right.
And this chart tells the story of pure psychological defeat. It's trading at 70.01, but the technicals show it is trapped inside a descending channel.
A descending channel is one of the clearest visual representations of a shift in market psychology.
Right.
The price chart effectively looks like a downward sloping zigzag.
And what that means in human terms is really fascinating. A channel is formed by lower highs and lower lows.
Exactly.
The lower highs happen because the people holding the stock are just getting impatient. Every time it rallies just a little bit, they panic and sell at a lower asking price than the last group did, just to get out.
And the lower lows happen because the buyers on the sidelines recognize that desperation.
They smell blood.
Basically. They know the sellers are panicking, so they refuse to step in at the previous support levels. They just wait them out, forcing the price even lower before they finally bar.
It is a slow bleed of confidence, and because of this descending channel geometry, our nodes show it is heading straight toward immediate support around the 67.17 mark.
Yes, and if the psychology doesn't shift by the time it hits 67.17, the sellers will just keep lowering their asking price.
Chasing it down.
Right, pushing it toward the next supports at 64.91, and then 62.8 is, and the resistance ceiling, keeping it pushed down, is way up at 75.35. You do not want to stand in front of a descending channel and try to catch it.
Okay, so we've mapped out the danger zones. We have PSO running out of gas at the top, TPL accelerating downward, and PTC trapped in a cycle of sellers constantly lowering their expectations.
It's a bleak picture if you're holding those.
It really is. But here's where it gets really interesting.
Okay.
A dropping, corrective market forces weak hands to sell everything, even the good companies.
That's true.
And that creates extreme value if you know where to look. Let's pivot to the accumulation zones.
These are the areas where the panic has effectively run its course and the selling pressure is completely tapped out.
We're focusing on two specific companies here: Gandhara Tire, ticker GTYR, and TPL Properties, ticker TPLP.
Right.
But to understand why these are accumulation zones, we need to really explain the mechanics of the stochastic RSI. We talked about the regular RSI measuring buyer exhaustion earlier with PSO.
Yeah, I did.
But the stochastic RSI is what analysts use to find these hidden accumulation zones. How exactly does it differ?
Well, to put it simply, the standard RSI looks at the actual price changes of a stock to tell you if it is overbought or oversold. It is a direct measurement.
Okay.
The stochastic RSI, however, looks at the regular RSI itself over a specific period. It measures where the current RSI is relative to its own historical range.
So it's effectively measuring the momentum of the momentum. It's like a second derivative.
Exactly that. It is hypersensitive to shifts in momentum. When a stock is being sold off aggressively, the regular RSI drops.
Right.
But the stochastic RSI plunges. It goes from 100 down to 50, down to 20, and anything below 20 is considered heavily oversold.
Think of the market like a thick industrial rubber band attached to a wall.
I like that.
The aggressive sell-off pulls that band tight. The standard RSI shows you how physically far the band is stretched. But the stochastic RSI is measuring the actual kinetic tension building inside the rubber itself.
That's spot on.
When that indicator drops below 20, you aren't just stretching the band, you are reaching the mathematical limit of the sell-off. Every algorithmic trading bot has hit its parameters and stopped selling.
Right.
Every panicked retail investor has dumped their shares. The physical limit is reached. And what happens to a rubber band when you stretch it to its absolute kinetic limit?
It has to snap back. I mean, the energy has nowhere else to go.
Let's apply that to TPL properties,
Yeah.
TPLP. This specific chart is incredible to look at. It's currently trading at 1490. But when you pull up the 4-hour chart, the stochastic RSI is sitting at 6.89.
6.89 is an extreme reading.
Really extreme.
As we noted, below 20 is oversold. A reading of 6.89 means that rubber band is practically vibrating. The sellers literally have nothing left in the tank.
And what's fascinating here is the divergence between the two indicators.
Yes.
The stochastic RSI is at that extreme 6.89, flashing a massive imminent snapback. But if you look at the standard RSI, it is sitting perfectly neutral at 52.69.
That divergence is the holy grail for a technical trader. Oh, yeah. The standard RSI at 52 tells us the stock is nowhere near that dangerous 70-plus overbought territory we saw with PSO. It has a massive amount of empty road ahead of it before it hits a speed limit.
You have the tension of the snap, courtesy of the stochastic RSI, and the open road to run, courtesy of the neutral standard RSI. It has the catalyst and the capacity.
And when you layer the price levels over that momentum data, the strategy becomes incredibly clear. TPLP is trading at 1490, consolidating right beneath the historical resistance ceiling of 15.04.
Okay. And right below where it is currently trading, it has an immediate floor, a horizontal support level at 13.69.
Exactly, and even lower support at 11.04.
Yeah.
This provides a strictly defined buy-on-dip strategy.
Because the risk is managed.
Right. If you implement a buy-on-dip near 14.0 or catch a slight drop toward 13.69, you have a historical floor protecting you. If the momentum data is right and that rubber band snaps, it will easily break through that 15.04 resistance ceiling.
Wow.
Once it breaks that ceiling, the next significant block of sellers doesn't appear until 15.49 and then way up at 16.13.
So you are risking a very small protected drop to 13.69 in exchange for a high-probability explosive move upward. That is why the analysts flag it as an accumulation zone. You accumulate shares while everyone else is too afraid to touch them.
Precisely.
Let's look at the second accumulation target, GTYR, ticker GTYR.
Okay, so GTYR is currently trading at 32.50. And this is the perfect counterexample to the despair we saw earlier with PTCL.
How so?
Well, while PTCL was trapped in a descending channel of lower highs and lower lows, GTYR is moving beautifully within an ascending channel.
And the behavioral psychology of an ascending channel is the exact opposite.
Complete opposite.
It means the buyers are so eager to get in, they aren't even waiting for the stock to drop back to its previous floor. They are stepping in and buying at higher and higher prices every single week.
The optimism is structurally built into the chart.
Right.
Right now, GTYR is testing the very bottom boundary of that upward channel. It is sitting near a horizontal level of 32.65, which used to be a ceiling of resistance, but has now flipped to become a floor of support.
It broke through the roof, and now it's walking on it.
Precisely. And the momentum indicator is flashing the same extreme signal as TPLP. The stochastic RSI on the 4-hour chart is hovering near absolute zero.
Not just below 20.
Well,
Zero.
no.
The rubber band is practically touching the floor.
It is a massive, mathematically oversold condition occurring exactly at the bottom rail of an optimistic, upward trending channel. The market is giving you a massive discount on a stock that fundamentally wants to go up.
So if that oversold condition triggers the bounce off the bottom rail of the channel, where is the ceiling? I see the support is down at 31.05 and 28.74, but what's the upside?
The upside resistance targets are 38.52 and all the way up at 45.64.
Wow.
Yeah, there is a massive amount of clear air above it if it reverts to the top of that channel.
So what does this all mean? We've thrown a lot of complex technical concepts at you today.
You really have.
We talked about descending channels, algorithmic exhaustion, and divergence in momentum indicators.
But it all comes down to stripping away the paralyzing emotion of a red market day. Yeah. For you listening, recognizing these specific mechanics, like a near-zero stochastic RSI resting on a historical support floor, is how you find clarity in the chaos. The headline says the market dropped 2,200 points, but the data says the selling is exhausted.
While the majority of the public is looking at the KSE-100 chart and hitting the panic button, the smart money is quietly identifying the exhausted sellers in stocks like TPL Properties and GTYR.
It is about ignoring the surface noise and reading the currents pulling beneath. Knowledge in this arena is a protective shield.
Absolute.
Understanding these technical indicators gives you a roadmap to step back from the emotional reaction of seeing your portfolio dip and instead read the actual quantifiable behavior of the market participants.
It lets you be the calmest, most clinical person in the room when everyone else is shouting.
Exactly.
But before we wrap up today, I want to leave you with one final lingering thought, and this is built strictly on that initial macro data we started with. We established right at the beginning that the KSE-100's current 2,200-point downward slide is happening on noticeably lower 4-hour volume than its recent peaks. The car is rolling backward, but the engine is barely revving.
Right. The 150 million shares traded versus the 185 million average, the energy is just missing.
This raises a massive contrarian question. If the market is dropping, but the actual volume of shares being aggressively traded is tapering off, does that mean the selling pressure itself is largely an illusion?
It is the multi-million-dollar question.
Could this entire corrective phase we're sitting in right now just be a macro-level coiled spring?
Wow.
Just a temporary vacuum waiting for the heavy mid-July level volume to inevitably return and trigger a massive violent breakout to the upside.
It's entirely possible.
It's something to deeply consider the next time you look at a red market ticker and feel that urge to liquidate your positions, because the data might not be telling you to run for cover.
No, it might not.
It might be telling you to get ready for the launch. Thank you for joining us as we unpack the underlying mechanics of the market today. Stay curious, keep questioning the headlines, and we will see you on the next deep dive.